Good afternoon, everyone.
Good afternoon, Professor.
Good afternoon. Yeah, today is the final class, last class for this semester. Okay. You guys seems to working very hard. I got a lot of emails from you guys. I like militarism. Yeah, I understand that you guys really, yeah, keen on getting a good grade. Yeah. Right. In Daejeon, do you guys have snow? No?
Yeah, it was
Yes.
a few hours ago.
Okay, I see. Yeah, I also had some snow, but it all is melted away. Almost melted away. It's almost gone. Okay, today we are going to have some review of some questions. Yeah, during class, and generally it's going to be Q&A session. Okay, because I'm not going into each slide of the previous lectures, so we are just going through the questions. And I already sent the files right previously, so I think you guys had a time to review these questions. So while working on these questions on your own, you may have some questions, right? So I think this is the last chance to this before the exam to sort out anything unclear, okay, in terms of understanding or whatever. I also made some mistake. One mistake is that one of your students pointed out, so I corrected it. So, okay. So first of all, I think you guys need to focus on concept. Because most you guys are wanting me to give the answers to all the questions, so I did. I tried. I did as possible. But one thing I like to say to you guys that in terms of when it comes to exam, the exam questions, I do not. Most of the questions is not about the simply applying the formulas to some cases. It's more about your understanding on the concept, okay, rather than do some math, right? So that's one thing I like to stress out. And you guys must be online by 2:25 p.m. on Thursday, okay? And just in case, put yourself on upside down, if it's out here, okay? So just in case. Okay, capital budgeting. So one of his students asked me to explain about this question. So I gave you this answer for IRR and MPB when it comes to reimbursement and its usefulness in capital budgeting. So any questions about this? I mean, not just about this question, but generally, any questions related to MPB and IRR, internal rate of return? No, you guys didn't encounter any problem?
I have a question about the last exercise in this section with the Excel document attached.
Excel document.
You made the corrections to this task where we have to calculate MPV and IRR to that part.
This one?
Yeah. Yeah.
Okay.
Can you explain why do we have 150,000 left in working capital, and how did you get this? And 142,000 fixed assets. I didn't get why we still have these figures here.
Okay, so here, the project requires initial investment in net working capital of 150,000, right? So initial investment working capital means that working capital, so you need to purchase raw material, right, to manufacture goods. Raw materials, yeah, raw materials, and raw materials is gonna be the same as inventory, right? So this sentence and this one, initial investment, that working capital means that you need to convert your cash into inventory, or after you sell the finished goods, you may not collect your sales in cash right away. So you may have account receivable, right? Account receivable means that you actually delay the payments by the customers for the goods you sold to them, right? So this initial investment, that working capital, means that you're gonna have account receivables or inventories, right? So that amount would be initially $150,000, right? So this is a cash outflow, right? But when the project ended, right? When the project ended in 3 years, right? 3 years, this account receivables and inventories, whatever you had in the beginning of this project, this initial investment in net working capital is supposed to be cashed in, right? Any account receivables or inventories that you made initially, you invest initially in the beginning, supposed to be cashed in because the project is ended. That's why this $150,000 of working capital turned into cash flow at the end of the project.
So like these things, they do not depreciate. We don't like use them, so they have the same value in 3 years, right?
Oh, working capital or inventory account receivables are not depreciable asset, only fixed asset, okay? Only fixed asset, except for land, only fixed assets such as machinery or building or any fixtures, those are the depreciable assets. Yeah, so this working capital, the value of working capital is the same as the book value, not depreciable.
And another question about 142,000 in the next slide. Why we are discounting it without in power of 3, or we are not discounting? Like, how did we get this value?
This one, I think this one comes from fixed asset, right? So fixed asset this fixed asset will be depreciated over the 3 years, right? So then in terms of book value, this is going to be 0, right? Book value is going to be 0 in 3 years. Book value in 3 years, book value of a fixed asset is going to be 0. But because project is ended, we do not use this fixed asset anymore. So we are going to sell. We are supposed to sell this fixed asset, right? So if you sell the fixed asset, you are going to receive the market value of the fixed asset. So then here, what's that? Oh, market value. Market value of fixed asset, even though in terms of book value, this is going to be 0. But as I said, I think I had there was one time when I explained to you guys about the difference about what depreciation is about, right? So depreciation is mainly based on the accounting principle, right? So book value is based on the accounting principle. So even though the book value is 0, it does not mean that the fair market value of the asset is also 0, because the book value and fair market value is totally different. So when you sell this fixed asset after as the project is ended or finished, the fair market value is $185,000, right? So you're going to receive $185,000 when you sell this fixed asset. Then what is the gain? The gain is $185,000, right? This is your gain. So as I understand, you are supposed to have this, going to receive this $185,000 in cash, right? But this gain is subject to tax. So tax rate is 23%. So except for tax 0.23, then you're going to have this amount. Clear?
Yes, thank you.
Okay. Okay, so I understand you guys know question of first one, and this one is clear. And any more questions related to capital budgeting, such as NPV, IRR? No. Yeah. So there's no questions in the exam that requires some calculations as to NPV and IRR, but just the one or two questions about the concept. Yeah. Okay. Risk and return. This one is pretty straightforward, right? And this one is also, it looks a little bit complicated, but just the application of the formulas, right? Yeah. So what I said is that what I'm saying is that I do not give you these types of questions in the exam. Okay. No. Okay. Any questions? No. How about this? Was okay? Okay. So for each state, economic state of economy, we have a portfolio return, and based on this probability, we can calculate the expected return of a portfolio, right? And then based on this portfolio return for state, we can, and using this expected return, we can calculate the variance for each state, and then, yeah, multiply with the probability, and then you can get some variance, and square root variance is a standard deviation. Okay, I think you guys pretty clear about that. No problem. This one, no question. Capital market efficiency, semi-strong, inefficient. The fundamental analysts, they look at the fundamentals of the company. Fundamentals means that balance sheet numbers from balance sheet, income statement, and or other financial statements. So they look at the financial statement and the business strategy and all sorts of information about the company. Then based on these past and current information publicly available, they analyze the stock using various types of techniques. So if there's any differences in the between the market price and intrinsic value based on their fundamental analysis, then they're gonna pick up those stocks and to materialize the additional return, such as which is called alpha. So usually the semi-strong market, the market price supposed to be the same as intrinsic value, right? Because the market price is supposed to reflect all the public and past historical and public information into the price, except for the private information, okay, inside information. So they believe there is some inefficiency in the semi-strong market, semi-strong form efficient market. That's why they do analysis. Yeah. Beta and CAPM. You guys, no problem with have no problem with the beta, right? Now, simply speaking, beta is the market risk of a specific of an individual, okay, individual security. So this security usually means a stock, right? So when beta is higher than 1, then it means much more volatility than the changes in market return, right? When this beta is close to 1, then the return of this the individual stocks moves in hand in hand, almost hand in hand with the market return. Okay. Market risk.
Professor,
Uh-huh.
your market risk is the same as systematic risk, right?
Sure. Investors prefer diversified companies because they are less risky. Not diversification within the company, but diversification of investments in various companies. Okay. And the stocks were perfectly positive related diversification would not reduce risk. Diversification would not reduce if the stocks were perfectly positive correlated. Diversification will not reduce. So you guys understand this? This one important, okay? I'm gonna give you one hint. Yeah, this one is important, okay? For the final. Diversification over a larger number of assets completely eliminates risk. Okay, the risk is 2 types, as mentioned just before: systematic and unsystematic. Okay. Diversification works only when assets are uncorrelated. That's correlated. Okay, uncorrelated means that correlation is 0. But even though correlate is not 0, as far as there is less, they are not, as far as they are not perfectly correlated, diversification could work. Diversification reduces the portfolio beta. Yeah.
Can I ask something?
Sure.
So can you back to the previous slide? In terms of B, if stocks were perfectly negatively correlated, how would diversification work? Perfectly negatively correlated.
Perfectly negatively correlated. Right. So then perfectly negatively correlated means that they if one stock moves, if one stock's price is increased, the other one supposed to be exactly, right, decreases, right? So then this is good, right? You can reduce risk, market risk.
And
But
in that case, would diversification work the best if stocks were negatively correlated?
yeah,
Yeah, it will work the best.
work the best.
I mean, like,
Yeah, so diversification means that you expect as a low you expect a low positive correlation among the stocks as possible. So if they show negative correlation, for example, you're gonna purchase one stock in the oil industry, right? And you have a stock in not negatively. Anyway, oil and the oil industry versus stock in green energy, right? So they may be negatively correlated, right? So then if oil prices goes down, then yeah, the green energy stock may goes up like that, right? So then the diversification works. Okay, so negative correlation, perfect negative correlation, yeah, would be good in terms of reduction in reducing risks. But positive correlation means that there's not much diversification effect, right? If they move together, what's the point of it? Where is the effect of diversification, right? Diversification means that we want to invest in different types of stocks, right? If they move together, then in terms of sensitivity of all the stocks in your portfolio to risk is the same, right? So not diversification. Clear? Okay. Beta less than 1 unless returns are perfectly correlated. Yeah. Portfolio each one have a beta of less than 1. The returns are perfectly correlated. Yeah. Right. And stock with a low standard deviation always contribute less portfolio risk than a stock with a higher standard deviation. Low standard deviation may help reduce stock risk, but not always, since positive correlation stock with a portfolio could increase portfolio risk. Lower. Stock with a low standard deviation always contributes less to portfolio risk than a stock with a higher standard deviation. Lower standard deviation may help reduce portfolio risk, but not always, since positive correlation of the stock with the portfolio could increase. What am I saying? A stock with a low standard deviation always contributes less to portfolio risk than a stock with a higher standard deviation. G. First, lower standard deviation may help reduce portfolio risk, but not always, since positive. I think the answer is not correct. since past, I wrote this answer, but now I realize something's wrong, right? The question is the comparison of lower standard deviation and higher standard deviation, right? Did you guys have time to read this question? So stock with a low standard deviation always contributes less to portfolio risk than stock with a higher standard deviation. Where standard deviation actually consists of two types of risk. One is systematic, the other one is unsystematic, right? So low standard deviation, we don't know which one is low, but anyway, low standard deviation, portfolio risk then low. Right. This is not about the standard. The portfolio risk. Okay. Yeah. I think this is correct. Yeah. Not this one. Do you guys understand this question and answer?
But does it also depends on the weight of the portfolio, if you know what I mean, like the proportion of the portfolio? Let's say a low standard deviation stock, but it has like 90% of the portfolio, then it doesn't always contribute less. I mean, the statement is still false, right? But it doesn't mean it really depends on positive correlation only, but it also depends on the weight, like how you distribute your investment among these stocks.
Yeah.
Does that make sense?
Yeah. So portfolio risk is about portfolio. At the end of the day, portfolio is about diversification, right? So as far as whether the individual stocks that has a high standard deviation, low standard deviation, the point is that, as you said, the correlation among the individual stocks within the portfolio. So even though, as I said it here, I think even though the stock with the low standard deviation, if the stock with the low standard deviation has a positive correlation with the other stocks, then the addition of that stock with a low standard deviation would not reduce the portfolio risk, because the higher correlation with other stocks do not reduce portfolio risk. So at the end of the day, the portfolio risk is not about the standard deviation, but the correlation of stocks with others. Okay, that's why, because my answer is not perfectly clear, so I should have said that lower standard deviation may have reduced portfolio risk, but not always, since positive correlation of the stock with low standard deviation could increase portfolio risk, right? So may not help reduce portfolio risk. That's what that could be the more could be a clear more clear answer. You get it? You get it? Still unclear? Correlation. Portfolio risk is not, portfolio risk is overall risk of the stocks within the portfolio. So standard deviation with individual stock is less important than its correlation with other stock as a whole. in the portfolio. So the point is not standard deviation, but the correlation of the stocks with other stocks in the portfolio. That's the key. So not about lower, higher standard deviation, but about correlation when it comes to portfolio risk. Okay, if you simply say, if the statement is like a stock with a low standard deviation is less risky, less risky than higher standard deviation, then that statement is correct, right? But when it comes to portfolio risk, stock with a low standard deviation or versus a stock with a high standard deviation, it is not the standard deviation of each individual stock is not the key factor in determining the portfolio risk, but the correlation of the stocks of individual stocks with the portfolio, the rest of the stocks is much more important when it comes to portfolio risk. Okay. The contribution of stocks to the risk of a very diversified portfolio depends on its market risk. Its standard deviation correlation with the portfolio. First, the contribution of stock to the risk of a well-diversified portfolio depends on its market risk. Market risk means the beta, right? So correlation.
It's true. It should be true because what you said with the previous statement is that it's not correlation with the portfolio. But if you put it as the answer for H, like you wrote on the slides, then it like overlap with what you just said previously.
Yeah, I'm thinking of that. The contribution of a stock to the risk of a very diversified portfolio means that the correlation each of the stocks, right, is not very positive. Depends on its market risk. Market risk is the beta. Market risk beta. Market risk. Market depends on market risk. Do you think it depends on market risk? It only depends on market risk.
Professor, I'm lost. What we are discussing now? I just don't understand the points. What we're speaking now about?
Okay, we are talking about a portfolio risk and its main factors contributing portfolio risk. Okay. So portfolio is the let's say a portfolio is the collection of various stocks, right? Here, the very diversified portfolio means that contribution of, as I stated in the previously, the contribution of stock to the risk of a very diversified portfolio is not about its own risk, but its correlations with the stocks in the portfolios, So correlation is not the same as market risk beta, right? Where market risk beta, the beta is the sensitivity of individual securities to the whole market, right? But that doesn't tell the correlation of that stock with other stocks in the portfolio. So when you add or deduct stocks to or from portfolio, the key is not the systemic risk or market risk of the single of the individual stock, but the correlation of that individual stock with the other stocks in the portfolio as a whole. You know what I mean? In that sense, the contribution of a stock to the risk of a various portfolio cannot just depend on its market risk. More depend on correlation of the individual stock with other stocks in the portfolio. Okay.
But can I tell you what I think about this?
Mm-hmm.
So according to the textbook, a well-diversified portfolio means that the unsystematic risk is like generally non-existent, correct? Because it's well diversified. So virtually there's no unsystematic risk.
Mm-hmm.
So usually a risk of a stock is systematic and unsystematic, but if the unsystematic risk is like gone, then mathematically speaking, it depends on the systematic risk of a stocks, how much it contributes to a portfolio, right? Then it depends on beta, which is the market risk. So it is true.
Yeah. So if the portfolio is very diversified, right? As you said, unsystematic risk should be gone. So what is left is only systemic risk, market risk, right? So, but here we are talking about whether the contribution of a stock to the risk, right? So we need to think of whether one single stock should be added or not added, right? Because the question is contribution of a stock. Contribution of stock means that what these stocks plays out in the portfolio when it comes to increasing or reducing portfolio risk or market risk, right? So,
but Professor, if the portfolio is well diversified, then two stocks there should have like, but it's impossible that like all the stocks have perfect negative correlation with each other. So like, well, that's difficult.
yeah.
But I think it turns back to well diversified. So that means the correlation wouldn't be a big of a problem, right? Because it's well diversified. Then we turn back to the fact that, oh, there's no unsystematic risk, the correlation is okay. Then it depends on market risk because it's well diversified.
Right. The question,
If we speak about the portfolio, like the result of the risk of the portfolio, but if we look into the portfolio, we need to define the contribution of each stock to this portfolio.
Yeah, let's read this statement. The contribution of a stock to the risk of a well-diversified portfolio depends on its market risk, right? So this statement is that, okay, depending on what beta is of a stock, if a beta is high, let's say beta is 5 or -5, right? If one single stock has a beta -5, then if the beta of a single stock stock has a -5, or then do you think a portfolio risk would reduce because of this or if it's -5, then portfolio risk would reduce. Risk is how much risk is at the end of the day the deviation from expected return, right? So beta means the sensitivity of return to the market changes in market return. So beta does not determine I don't think the beta determines the risk of a portfolio, even if it is well diversified. The key is whether this single stock, how this specific stock plays out with other stocks in the portfolio as a whole.
But even if what you say is true, there is a part in this statement that is still true. If you say it's false, it's not false, right? Because it does depend on market risk. So if we say the statement is false, it's not. It's just lacking information, if that's what you're saying. So we cannot put it as false. Right? Because it doesn't say depends only on. It just say depends on, which is true.
Contribution of stock to the risk of a very diversified portfolio depends on its market risk. So you say partly depends on market risk?
Yeah, because if we think about the formula of how we calculate the risk of a portfolio is the weight of a stock A multiplied by the risk of stock A plus the weight of stock B and blah, 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 like that, right? Mathematically speaking, it's still true because market risk is still a part of the formula. So it does depend on it.
I got it.
So I think to say it's completely false is not.
Contribution of stock to the risk of a very diversified portfolio depends on its market risk. Where? Not sure. Let me think it over, okay? And then I will get back to you with the separate emails, okay? We consume too much time on this. Okay, I will get back to this question, this statement, okay? After this class. A very diversified portfolio with a beta to 0 is twice as risky as the market portfolio. That's true. Very diversified portfolio with a market beta of 2.0, twice as risky as the market portfolio. Contribution. Okay. Okay, I'm gonna go back to this. Get back to you guys on this. How about this market risk? So this is just the application of the formulas, right? To each question. Not a big problem. And this one is also just a simple application. Okay. The one thing is that you guys understand this part. So negative weighting means borrowing. Okay. So here, risk-free, weighting of risk-free asset is -1. So it means that we borrow funds at risk-free of 3.5%. Okay. Okay. Is it possible that risk asset could have a beta of 0? Yes. But beta is only systematic, major systematic risk, right? So risk asset could have unsystematic risk, still have some risk. Any question in this on this exercise for CAPM? Expected return is just when the beta is 0, the expected return is the same as risk-free rate. Is it possible there a risk asset could have a negative beta? Yes. What does this CAPM predict about expected return on such an asset? Positive in opposite to market return when the beta is negative. Okay. This is pretty plain question. Okay. You just need to have you just need to get only the weighting for stock F. Okay. And not a very complicated one. Any question as of now? No. This one is also simple application of this formula. Okay, and MM's position. MM's positions assume perfect financial markets with no distorting taxes or other imperfections. True. MM's position 1 says that corporate borrowing increases earnings per share, but reduces the earnings price earnings ratio. First, this is about MM2. MM2 says that cost of equity increases with the borrowing and increase in proportional to debt value, debt form value for proportional to debt equity. MM2 assumes increased borrowing does not affect the interest rate on the form. Yes. Any questions? No. So this one is okay. Okay. So you guys need to know this one. So current value. Understand this calculation, right? And so unlevered value means that financed with only equity, right? So this is the this is the value of the firm when it is not levered. So
Can we run through these propositions again, because they are a bit confusing? What belongs to what? Maybe we can just get an overview again about all of them.
this one,
Like the theory behind these propositions with taxes and without taxes, because like it's confusing what we are using. Like proposition 1 with taxes, without taxes, like it's a bit confusing. Maybe we can just get an overview again about them.
the MM's position with the tax or without taxes.
Like the whole topic of the propositions, like all of them.
This one, this all of this position. And you want to go run through the MM's position again?
Yeah, if possible.
Okay, so basically, MM's position 1, right, without taxes, the capital structure does not make any difference to the value of the firm, right? That's the MM1. MM2 is that cost of equity without taxes, the cost of equity increases in proportion to the debt to equity, right? But in terms of a value of firm is the same as before, okay? Because increased cost of capital will be offset by the higher earnings per share, right? That's the MS position 1 and 2 on the without taxes. But with the taxes, the only difference, the significant difference in terms of the firm value, the key firm value is that because of the tax shared, the tax benefit from the debt investment, if we have taxes, so the firm value could increase by this tax benefit. Tax benefit is calculated by debt multiplied by tax rate. Okay, because the tax is, the interest is a tax deductible, right? So the more that you have, the higher the tax benefit will be added to the firm value. In the later part of the MM's position, because of a bankruptcy cost, or because of bankruptcy cost, or other such of risks, there should be some optimal trade-off between tax benefits and other costs, right? So there must be some optimal capital structure. So the whole point of MN's position is whether capital structure could add value to the firm value, but without, only with the taxes and other if you think of only taxes, then the tax benefit could increase the firm value, right? But without tax, capital structure would not make any difference to the firm value. That's the MM position, regardless of 1 and 2. Okay, without taxes. With the taxes tax benefit increase the value to the firm because interest is tax deductible without considering any other bankruptcy cost and something, any other, market, any consequences from the debt, too much debt. It's clear?
Yeah, thank you.
Mm-hmm. So this is the unlevered value, and based on this unlevered value, you just need to add the tax benefit, right? Then you can have the value of the levered form, right? So levered form versus unlevered form, the difference between the two is whether difference is tax benefits, right? Why? Because interest is tax deductible. That's the assumption. Not assumption, that's the reality. Yeah. Okay, this is the WACC. So pretty simple, right? So the reason for using debt rather than preferred stock is tax benefit, right? This tax makes difference. Cost of equity. Understand this formula, okay? As I said, the cost of equity increases as you have more debt. So this is the formula, right? MM2, right? Right. Dividends. You guys had time to read these questions? Any question? You guys understand this question? Dividend is subject to income tax, 28%, right? But the capital gain is not. The capital gains tax rate is 0, right? So the question is, what is the pre-tax recovery return on Gordon's stock? So Gecko pays no dividends, so the return from Gecko stocks is not subject to tax because the return is going to be only capital gains. Okay. But the part of the Gordon's stock, part of the return from Gordon stocks come from a dividend, right? So that dividend is supposed to be subject to tax at 28%. Okay. So get partly dividend year, partly capital return of Gordon's, right? Should be the same as Gecko, 12%. 12%. The dividend yield is reduced by the tax amount, right? So capital return is 9.48. So if you add this 9.8 and the 3.5, then you have a golden spread tax return. Understand this question? It's a little bit complicated, but not that. No question? Dividend policy and the cost of capital. So whether you have a make distribution or not, it does not affect the cost of capital return return, okay? Retained earnings also requires the same cost of capital because this is also part of the equity. Retained earnings also part of equity. If a company purchases stock instead of paying dividends, the number of shares for the earnings per share, the stock repurchase must always be proposed to paying dividends. However, it is true that purchase of stock reduces number of shares and increases earnings per share. However, the stock repurchase is not always preferred to dividends. Since stock repurchase is the same as the sale of shares, if you forecast the future increase in the price of share in the future, you may not prefer the stock purchase, but just keeping it receiving dividends. Make sense? Current price per share. I think you guys know how to calculate this, right? The price of the share. Then you divided the share price by number of the shares. And so I mean, you need an additional fund to make dividends, right? The difference between the two. This one or, oh yeah, this one. Yeah, this one. Any question about this problem?
I think for like the number for B, I calculated as 2,250, not 2,520. I'm not sure. Can we try this one?
2,000. Okay.
So
Dividend.
it would be 130,000 divided by the price of the stock, right?
Stock price is this one.
Yeah.
Then
Oh no, sorry. It's true. It's correct. I remember it wrong. Yeah. Never mind.
yeah, this one should come the number of new shares to issue, right?
Yeah, it's two.
Maybe wrong, but the formula is like this.
Yeah, the number is right. Sorry.
Yeah, and that's okay. And new price for a share, existing share. So the value of the firm does not change. Okay, the market value of the firm does not change, even though new shares are issued, because yeah, it does not, the issuance of new shares does not affect, so it's not supposed to affect the value of the firm. So we simply divided the total number of shares. Yeah, we divided the previous value, total value of the firm with the total number of shares. including this one. International finance. You guys understand this one? There's one question, okay, about this arbitrage. So you don't have to calculate the whole arbitrage, the whole arbitrage transaction. You don't have to conduct or arbitrage transactions, but to find the arbitrage profit. But you should guys understand how understand the procedures. Okay. So there's one question related to this interest arbitrage. So just let me know if you guys understand. If you guys do not understand, then please let me know. I tried to explain. You can also find that this question from textbook, but my explanation is a little bit different from textbooks. But anyway, if you understand this explanation, then you guys might have any problems with the questions in the exam. I guess okay. It's too much to cover in 1.5 hours. So that's why I just go through the questions related to the topics. Actually, I thought about the slides from each chapters, but I think I don't think I can cover all the topics in that manner. So I think it may be better to go through the questions we have not solved during class. So if you guys have any questions, then please ask me right now. Any part you want to clarify further?
We have some working capital questions left in the slide. Not here. Here we don't have any working capital. Do we need to solve them, or we're not going to have the practical tasks on
Net working cap, not net, just working capital.
Net working capital? Do you mean net working capital management?
Yeah, like we have a few tasks in the lecture slides.
There's one question related to net working capital management, but not about calculation, but about understanding. Understanding about. The question is related to the cycle. Okay, so operating cycle, cash cycle. So not about questions, not about calculation, but about understanding the general concept of operating cycle and the cash cycle. And yeah, there will be one. Yeah. So I tried to make the questions as easy as possible, but I'm not sure how you guys take it. Yeah, I tried it. And I will get back to this to you guys on this one later after this class. Okay. This one. Any other questions?
Since we have time, can you go over the arbitrage one?
Okay. Yeah. In this arbitrage question, first of all, you need to know our assumption is that compound interest rate parity works. Okay, that's our assumption. So based on assumption, you need to see whether the forward rate is in line with the assumption, whether the compound interest rate parity works here. So if you calculate forward rate based on these interest rate, the compound interest rate parity formula, you have 1.9091, right? But this is not the same as in this market. It's the forward rate, 1.9, right? So we can assume that, oh, there may, therefore under the compound interest parity, there's an arbitrage opportunity, right? Because forward rate is not the same as the results based on the interest rate parity. So here, in the future, we based on our calculation, the Swiss franc should be 1.9091, but in the market, Swiss franc against the dollar is 1.9. This means that in the market, Swiss franc is overvalued in the forward market, right? So it will be most beneficial to exchange or sell overvalued Swiss franc at the overvalued price by entering into forward contract at this one, right? So we borrow $1 and exchange it into 2 Swiss francs using the spot rate, right? And then these 2 Swiss francs will be invested in Switzerland at 5% interest rate, right? So then in period 1, in year 1, the amount will be 2.1 Swiss franc, right? In year 1. Then, because we entered into forward contract, right, at Swiss franc 1.9 is $1. So we can sell Swiss franc at 1.90 to buy $1, right? So then you're gonna have $1.1053. But since you borrowed the dollar at 10% interest rate, so you have to pay back $1.1. So if you deduct $1.1 from your total return of 1.1053, you have $0.0053 as a gain without any risk. So the assumption is that there's no transaction cost and the capital can move freely. So the assumption is that there's no taxes, any transaction costs, we can take advantage of these differences in forward rate. That's the assumption. Okay. You get it? Okay, I think the textbook is a little bit confusing, but maybe you guys report to textbook as well. But okay, so this is a Morris or. Okay, so good luck with your final exam. I gave you, as I said, do not focus on calculations, but more on the concept, understanding of the concept. Okay, please do not dismiss the articles I introduced in the slide. Okay, as with the midterm exam, I always use the articles in the slides. Okay, at least one. So try to also read the articles and then understand that. Okay, that's all I can say for your final exam. And bring your calculator just in case you may need some calculations. Okay, so during this semester, this semester, I really enjoyed teaching you guys, and one of you guys may not, some of you guys may not be happy with my teaching, but I tried to do my best to deliver all the not all the key parts from the textbook as possible. So my initial goal was to cover to generally cover all the chapters of the textbook. So I sort of did that, but this within 6 months, it is almost impossible to cover all the parts of the textbooks. It was really challenging. Anyway, I hope you guys have a more interest in finance. If you do, then please try to read some news articles as one article a day. Okay, that'll be really helpful. Okay, good luck with your final exam, and this is all for this semester. Thank you very much, and have a great winter vacation.
Thank you, Professor.
Thank you, Professor.
Thank you.
Thank you,
Thank you.
Bye bye.